Your money-making broadcast starts now. Markets closed sharply lower today as inflation fears returned with force, sending global equities into a broad sell-off and pushing bond yields sharply higher. The S&P 500 lost 1.2%, the Nasdaq Composite declined 1.5%, and the Dow Jones Industrial Average fell 1.1%. It was a day of nearly universal weakness across almost every sector. Technology, financials, consumer discretionary, and industrials all took heavy losses. Only energy stocks managed to hold their ground, and that divergence tells an important story about where institutional money is flowing. For Canadian investors, the selling pressure hit particularly close to home. The TSX heavy weighting in materials, industrials, and financials, sectors that get crushed when rate expectations rise, meant the pain was broadly felt from Bay Street to Vancouver. But beneath the surface, there are important divergences and opportunities worth understanding. We predicted this correction was coming with a 65% probability, and today it arrived. Let's break down exactly what happened, why it matters for your portfolio, and where to look for safety in this turbulent environment. The trigger for today's sell-off is clear: inflation fears. The latest producer price data came in hotter than expected, reviving the nightmare scenario that markets had hoped was behind us. Bond yields surged in response. The 10-year Treasury yield jumped 12 basis points to 4.68%, as traders repriced the likelihood of a higher-for-longer Federal Reserve. Rate-sensitive sectors bore the brunt. Real estate fell more than 2%. Utilities dropped. Consumer discretionary stocks were crushed. For Canadian investors, the cross-border implication is direct. A more hawkish Fed puts upward pressure on the Canadian dollar and raises borrowing costs for Canadian companies with US dollar-denominated debt. It also limits the Bank of Canada's room to cut rates independently, since rate divergence would weaken the loonie and import inflation. This is exactly the correction we warned about. Yesterday, we noted that the S&P 500's RSI was at 82 to 83, deep in overbought territory. We assessed the probability of a near-term pullback at 65%. That correction has now materialized. The legendary investor Michael Burry has been cautioning about bubble parallels in the current market, and while today's action does not signal a crash, it confirms that elevated valuations needed to cool off. The constructive interpretation is that bull market corrections like this one restore healthy conditions. They shake out weak hands, reset sentiment indicators, and create entry points for disciplined capital. Nowhere was the divergence more visible than in energy. ExxonMobil rose 3.4% today, making it one of the few bright spots in an otherwise red screen. The catalyst goes beyond sector rotation. Oil is edging higher as the Trump-Xi summit in Beijing approaches, with markets hoping for a trade breakthrough that would boost global energy demand. For Canadian producers, this is a direct structural tailwind. Enbridge, Suncor Energy, and Canadian Natural Resources are all leveraged to sustained elevated crude prices. The TSX Energy Index remains among the best-performing sectors year-to-date, and the fundamental case for Canadian energy has rarely been stronger. Unlike many sectors that are cutting spending and reducing guidance, energy companies continue to generate free cash flow at levels near decade highs. This is why institutional money is rotating into energy as a safe haven. The auto sector tells the opposite story. Ford plunged 7.5% to $13.40, its worst session in months. General Motors fell 3.7%. The auto industry is under severe pressure from multiple directions: rising inventory levels, potential tariff complications under the ongoing trade review, and weakening consumer demand, especially in the subprime segment where auto loan delinquency rates are climbing. For Canada, this is a direct economic concern. Ontario's auto parts supply chain is deeply integrated with U.S. assembly plants. A prolonged downturn in U.S. auto sales would ripple through the Windsor to Toronto manufacturing corridor and into Canadian GDP figures. Investors with exposure to Canadian auto parts suppliers or transportation equipment manufacturers should be monitoring this closely. The semiconductor sell-off was equally brutal but more nuanced. Intel fell 6.2%. AMD dropped 5.7%. Broadcom lost 3.3%. The entire chip complex sold off as the market rotated away from the high expectation names that have led this bull market. However, Qualcomm gained 8.4% on positive AI chip demand signals, proving that this is a stock picker's market. For Canadian investors, this reinforces the importance of selectivity. Not all tech is created equal. The winners in AI infrastructure, companies with proprietary technology and recurring revenue models, are separating from the commodity chip makers. On the corporate news front, two stories stand out with Canadian relevance. BlackBerry announced a share buyback program following TSX regulatory approval. It is a signal of management confidence at a company that has been restructuring for years. Insider-led buybacks at depressed valuations are often the most reliable value signal in markets. Meanwhile, Cisco confirmed thousands of job cuts as part of a restructuring toward AI infrastructure, coming right after an earnings beat. Cisco's move reflects a broader corporate trend. Companies across America are aggressively reallocating resources toward AI while trimming legacy operations. For Canadian tech investors, the lesson is clear: own companies with a clear AI roadmap, not just broad tech exposure. Consumer debt also hit the spotlight, with new data showing delinquency rates rising in auto loans and credit cards. The two-tier economy is real. While high-income Canadians benefit from asset appreciation and low unemployment, lower-income households are feeling the strain of cumulative inflation and higher borrowing costs. This consumer stress is a headwind for discretionary retail, auto sales, and housing-related sectors, all of which are significant components of the Canadian economy. Let's turn to this week's stock picks through the lens of four investing legends. Our first pick is for the safety-minded investor, and we look at it through the eyes of Benjamin Graham, the father of value investing. He would point to Pfizer at $25.33. With a price-to-earnings ratio near 8 and a dividend yield above 6%, Pfizer offers a genuine margin of safety. It is a defensive pharmaceutical giant with a fortress balance sheet, essential products in an aging global population, and pricing power that protects against inflation. In a market environment where uncertainty is rising, Graham would argue that owning high-quality, undervalued businesses is the single best defense against drawdowns. He would remind us that the intelligent investor buys dollar bills when the market offers them for 50 cents. Our balanced pick comes from the legendary growth investor, Phil Fisher. He would be drawn to Enbridge, the Canadian energy infrastructure leader. Fisher built his career identifying companies with durable competitive advantages and superior long-term growth runways. Enbridge's pipeline network is a textbook Fisher investment, a tollbooth business model that generates predictable, growing cash flows through any economic environment. With energy infrastructure in high demand and North American production growing, Enbridge's competitive moat is widening. Fisher believed in owning great businesses for decades, not days, and Enbridge fits that mold perfectly. For growth-oriented investors, the disruptive innovation fund manager, Cathie Wood, would make the case for Enphase Energy, which surged 10.2% today to $52.89. Solar and renewable energy are at the heart of the global energy transition, and Enphase is the dominant player in residential solar microinverter technology. Wood's thesis is that disruption follows an S-curve, and solar adoption is still in its early stages. The Inflation Reduction Act subsidies provide a multi-year tailwind, and falling battery storage costs are making solar-plus storage systems increasingly economic for homeowners. She would argue that near-term market corrections create asymmetric buying opportunities in disruptive technologies. Finally, the legendary Fidelity fund manager, Peter Lynch, would focus on SoFi Technologies at $15.61. Lynch was famous for investing in businesses he could understand, companies whose products he used, and whose value proposition he could explain in a few sentences. SoFi's digital banking platform serves millions of members across lending, investing, credit cards, and savings. The fintech space is volatile, but SoFi is building a diversified financial super app with recurring revenue, fast-growing membership, and improving unit economics. Lynch would view the current pullback as noise in a long-term growth story. He famously said that more money has been lost preparing for corrections than in corrections themselves, a reminder that staying invested through volatility is the path to long-term compounding. Looking ahead, today's sell-off feels painful, but it is a normal and healthy part of a bull market. The correction we predicted has arrived, and that is constructive. It resets sentiment indicators, shakes out speculative excess, and opens entry points in high-quality names. The key now is to remain disciplined. Energy shows relative strength and offers Canadian investors a natural hedge. Defensive value names like Pfizer provide ballast. And high-growth disruptors like Enphase and SoFi offer long-term compounding potential for those with patience. The market's message today is simple: inflation is not dead, the Fed is not done, and stock selection matters more than ever. Own businesses with pricing power, strong balance sheets, and visible growth trajectories. Avoid the speculative froth. That combination has never failed a disciplined investor over a full market cycle. That is the market close for May 15th. I'm Chloe. Don't forget to like and subscribe. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.